Okay, welcome to the second episode of this brand new video series called The Professional versus Retail. Right, where in this series, I'm going to show you what is the different approach taken by the professionals and what is the approach taken by the retail traders, right? What is the different thing that the pros did where the retails do not, right? Now, as usual, remember to leave me your feedback below in the comment sections, because this video series is really depends on your engagement, right? So for some reason, if you're not interested in this and you are not engaging, right, with this, right, you're not sharing, or you're not liking this, I'm just going to stop this video series, right? Because from the data, it tells me that you are simply not interested in this, right? Okay, so remember to leave the feedback below and make sure to subscribe so that you will not miss future videos on this video series. Okay, so today I'm going to have a very brief talk, a very brief explanation and discussions on the different approach taken by the pros and the retails when it comes to risk management, right? It's very typical that when you open a retail guy, a trading account of a retail guy, you realize that they will have only like 2 to 3 position, right, in their portfolio, right? So maybe they will be long euro dollar, right, and they will short the S&P 500 index, and at the same time they will long maybe gold, for example, right? And they will call this a portfolio, where the truth is not, because the purpose of a portfolio is really trying to minimize the risk and maximize the overall return on the portfolio, right? So, and the position that you will have in your portfolio usually have a very low correlation with each other, right? So if one position went down, your remaining positions will not be affected because they are not correlated to each other, right? And retail trader, they simply will open 2 to 3 positions, where the pro, we are not allowed to do that, right? Because we understand that if we open only 2 to 3 positions, it will be very risky for us, because we are concentrating a lot of risk on these 3 positions, right? So if, let's say, one position went down, right, I'll be like down 25%, something like that. So instead of open 3 positions, we will have multiple positions open, right? So it depends on the institutions. A investment bank prop desk trader, right, he or she will have at least 20 to 30 positions open in the portfolio, right, which is a long short portfolio, right? So let's say there's a 20 positions open in the portfolio, right? So 10 of this 10 of the position will be a long position, and 10 of the remaining position will be a short positions, right? This is to really hedge off the systematic risk and other market risks, market risks, right? And basically is trying to reduce the volatility of the portfolio, right? So what they are trying to do is really just trying to minimize the risk, and they're trying to maximize the profits, right? So this is the first thing that the pro and the retails, the first difference between the pro and the retails, right? Now if you are a hedge fund trader, then you will go more intensive, right? You will have at least 30 positions open at any time, at any given time, right? Because you really need to suppress your volatility, your portfolio volatility, right, in order for you to follow up with the mandate, right? And this is the reason why most hedge funds are still in business, although they are keep underperforming the markets, right? Which I will go through on the next video, right? On the future videos, on why a lot of hedge funds are still functioning, are still in business, although they are constantly underperform the market, right? So you will realize that the professionals are really having multiple positions, and at the same time they will trade very less, right? They will trade less frequent, right? Because they understand that by trading a lot frequent doesn't mean that there's a lot of opportunity there, right? Trading more doesn't make more money. This is the thing, right? And they simply understand that short-term trading and high-frequency trading simply will not make you money, right? And if you look at the retail guy, they simply do the opposite, right? Which is they will trade as frequent as possible, but at the same time they will only have 2 to 3 positions open, right? By having only 2 to 3 positions, your portfolio will be very volatile, right? Your P&L will be very volatile, and you can be easily overexposure, right? Because you only have like 3 positions, and if you just leverage or if you just fully leverage them, you will easily overexposure and over leverage, right? And overexposure and over leverage is one of the main reasons why retail traders always lose money, right? So this is just a very, very brief discussions on the different approach taken by the pro and the retail in terms of risk management, right? I will go this deeper on other videos, on maybe another video series, right? Depends on your feedback, right? So remember to subscribe my channel and hit the bell so that you will never miss another future video on this video series. See you on next video.